Financial markets occasionally experience structural shocks, moments where liquidity evaporates and price action becomes highly turbulent. In these environments, many intermediate traders fall into a statistical trap. They assume a specific technical setup, like a candlestick pattern, carries a fixed, universal probability of success, regardless of the broader context. Retail strategies will often assign a static 60 to 75% win rate to a standard Morningstar reversal. But those probabilities are derived from generalized historical backtests. They aggregate decades of data, blending wildly different economic conditions into a single misleading average. To trade systematically, we have to isolate what are known as market regimes. These are distinct, measurable states of volatility and liquidity that govern how price actually moves. Applying a static probability to a dynamic, non-stationary system guarantees capital destruction over a long enough timeline. Markets are not mathematical vacuums. They are physical marketplaces driven by human emotion and institutional constraints. In a stable regime, volatility is low, supply and demand interact predictably, and participants process information at a rational pace. A crisis regime is the exact inverse. Triggered by macroeconomic shocks, it is defined by high volatility, rapid liquidations, and panic. To measure the exact impact of these environments, we can analyze an empirical study of 500 daily observations that tracks standard technical patterns across both regimes. The data isolates what happens to a historically reliable technical signal when the market crosses the threshold into a crisis. The results demonstrate that localized price patterns lose their predictive validity entirely, degrading into statistical noise the moment volatility spikes. A pattern's success rate is dictated by the environmental regime it forms within, not the geometry of the pattern itself. First, we establish a baseline by examining the control group, a stable, low-volatility market environment. This chart visualizes empirical confirmation rates for candlestick signals. Under stable conditions, the standard hammer pattern successfully signals a trend reversal 67.3% of the time. The bullish engulfing pattern performs even better, showing a confirmation rate of 70.5%. These high confirmation rates occur because structural support and resistance levels hold firm. Participants accumulate and distribute assets rationally, allowing localized signals to play out. This dashboard shows the underlying momentum data. During stable successes, average RSI and stochastic readings hover steadily in the neutral 40 to 45% range. These neutral readings confirm the market isn't overextended. The candlestick functions as a pure signal, uncontaminated by extreme momentum. Traders execute their setups in an orderly fashion, trusting the technical boundaries of the asset. In a low-fear environment, traditional charting works exactly as the textbooks claim it does. But when a sudden, severe macroeconomic shock hits the market, that previously orderly structure immediately and violently fractures. In the crisis regime triggered by COVID-19, we see a severe statistical collapse. The hammer pattern degrades to a 44.4% confirmation rate, while the bullish engulfing pattern plummets to 47.6%.
Both setups perform worse than a random coin flip. This line chart isolates the exact variable causing this decay, an extreme surge in market volatility. Compared to the stable baseline, the average volatility metric escalates violently, peaking at 0.39 for the hammer pattern. This surge in volatility physically overrides the localized supply and demand zones that candlesticks rely on. Buyers and sellers are no longer negotiating over price discovery. Operating on the assumption that your setup still carries a 60 to 70% probability during this regime will rapidly drain a trading account. The data proves that high volatility strips the predictive power entirely away from localized chart structures. To understand why the mathematics break down, we have to look at the psychological drivers underneath the price action. This heat map compares average RSI values across periods, showing how extreme emotion warps momentum indicators. Stable doji RSI sits at 43.3%. In crisis, it spikes to 63.6%, driven by loss aversion and panic liquidation. In an environment of extreme uncertainty, institutional and retail participants liquidate positions indiscriminately, slicing through traditional technical support lines as if they do not exist. The mathematical failure of the candlestick pattern is simply a symptom of a broader psychological breakdown in the market. This exposes the critical flaw in retail technical analysis. A standalone candlestick pattern is a signal, not a complete trading strategy. To trade systematically, that signal must be processed through a hierarchical decision tree. The first and highest layer of the hierarchy is measuring the macroeconomic environment. You must identify the current regime using volatility metrics before looking at individual assets. The second layer applies a momentum filter, determining if the underlying trend is orderly enough to support technical structures. The final layer is the localized price pattern itself. You execute the trade only when the candlestick perfectly aligns with the top two tiers. This strict order of operations acts as a circuit breaker. It protects capital by blocking trades entirely when the market enters a sub 50% probability regime. You cannot accurately interpret a localized signal without first measuring the macro environment it exists within. Professional traders operationalize this by tracking the width of Bollinger Bands or monitoring macroeconomic indicators like the VIX. When metrics breach a critical threshold, the strategy demands discipline to stay in cash, even if a seemingly perfect technical pattern forms on the chart. Traders who fail to contextualize their signals subject themselves to massive psychological and financial stress as they trade blindly into a crisis. Conversely, the regime-filtered trader operates with cold, systematic precision, avoiding the traps of emotional reaction. Chart patterns possess no inherent absolute power. They are simply visual representations of conditional probability. True alpha is generated by understanding the strict environmental limits of your mathematical models. In modern markets, the structural edge belongs to those who trade the context first and the signal second.